Hey guys, this is Jordan. Today we're going to talk about deductions. What are deductions? What can you deduct? What do you have to depreciate? We're going to get into all of it, okay? Deductions lower your tax bill, so they're good. You want more deductions than less because it decreases your tax bill. And if you've learned anything on this channel, we like to decrease the tax bill, okay? So that's what deductions do. And a lot of people come to me and they're like, well, what do I deduct? My general answer to most clients is, if it helps you to make more money in your business, it's most likely deductible. So just include it. And if a CPA gets your list of deductions at the end of the year to prepare your tax return and they see some stuff that they're like, well, that's not deductible, then they'll just not include it on the tax return. But for your purposes, just assume if it helps you in your business and you're spending money out, include it on whatever you give to your CPA at tax time. That's going to be easiest rule for you to go by. And then let the CPA really go through it and they will pick out what is actually deductible and what's not. And most things are going to, in fact, be deductible. Like there's a couple common ones that come to mind that are not deductible as of 2020 when we're recording this. Political contributions, not deductible. Entertainment, so if you go out golfing or you go bowling, you take clients to do anything like that, not deductible. If you put a meal involved with it, the meal is deductible 50%. The entertainment's not deductible. So those are a couple examples that come to mind of things that are not deductible. The other thing that comes up in the conversation is, do I deduct it, all of it in this current year, or do I depreciate it over several years? So for most people, depreciation, it's outside the scope of what you really want to understand. So let your CPA handle that. I'll let you in on an easy rule to go by. If it's under $2,500, you can deduct it. If it's over $2,500, you have to depreciate it. So at least that gives you just that standard basic knowledge of, okay, as long as the invoice is for under $2,500, I get to deduct it in the year in which I spent it. Okay, so that's a good rule to live by in that world. The last thing I want to touch on, because it's one that gets brought up over and over again, is the auto expense. You drive a car from here to there to yonder to make your money, right? There's two ways to deduct those costs on your car. It's going to be mileage or it's going to be actual expenses. So mileage is super simple. Mileage is just going to be, okay, the miles you drove for business purposes, you're going to take that total mileage number and you'll multiply it by the rate, which right now the rate's 59 cents per mile, which is great. A lot of people use the mileage way of going about deducting their auto expense. The other option is to use actual expenses. And this is where you would keep receipts for gas, maintenance, insurance, the whole thing. And you would just add all those numbers up and that would be your auto expense. The trick is each car, you have to decide the first year which way you're gonna go and you have to stick with it for that car. So if you choose mileage, you've gotta stick with it until you get another car and vice versa with actual. So mileage, for what I've seen, most people get a bigger deduction with mileage because you get 59 cents on every mile that you drive. And that's normally more than your actual cost of driving your car. So anyways, that's like kind of a brief overview of your deductions and what to include, what to give your CPA. And I hope that's helpful for you to understand because deductions, like we said, are really important. They decrease your tax bill. Thanks so much for watching. I'll see you guys soon.